Good morning, everyone.
Morning, Jason.
Morning, Jason.
Morning.
Morning.
It's raining, but it could be worse. We could be Albemarle County and have closed schools today.
Why?
It's raining, Heather.
My kids go to Albemarle County and they are home today.
Oh, wow.
Gotta love it.
Could be worse. Could be worse.
Jason, David Hughes is not going to be able to make it today.
Okay. Hey, Scott.
Hi, Scott.
So maybe just Markel, are we waiting?
Markel is on duty today, so he's going to try to, oh, no, I guess it's not him. Anyway, if he can, he'll be
Sorry,
here.
just me. Didn't mean to disappoint.
All right. Okay, well, I guess we'll go ahead and get started. The first item on the agenda is the approval of the minutes from June, which was the last time we met. So if anyone had any comments or questions, and if not, there's a motion to approve the minutes.
So moved.
Second.
All in favor of approving the minutes, say aye.
Aye.
Any opposed? Great. All right, we'll move on to the next item on the agenda, which will take up the majority of our time. Greg McNeely has joined us from Dahab Associates. They are the investment advisor for the fund, and he's going to be giving a report on the end of the fiscal year and anything else that he wants to talk about. So I believe you have the ability to share your screen if you want, but everyone should have copies of all the attachments that you sent.
All right. I guess I will go through the easy way first, which is my summary of the report. And if we need to go into further detail, I'll pull up the full report, if that works for everyone.
Sure.
Yes, sir.
It's amazing how proficient we've all gotten at doing this. So let me shrink this just for a moment so you can. So when I do this for you, I try to make it as easy as possible. Anything that's in green is a positive thing, or a manager that's beaten their benchmark, or some good news. Anything that's in red are negative comments or managers that have underperformed. So you can see as you go down through your summary, there's a lot of green in this report. So a lot of good has happened. And I'll start going through this as far as the total portfolio first. And I will zoom in again for you. So, the first bullet point, assets grew by a little in excess of $40 million last year. We went from $168.1 million as of last June to 214.8 as of this June. That equates to roughly a 29.1% return over your last fiscal year. Our allocation hasn't changed much from last year. We're a little bit heavier in domestic equity, even though we've made some trims. Most of that is large cap. And again, that's where a lot of the returns have been in large cap domestic equity. But this has not changed all that much. We do, again, trim our equities and when you have to take cash out of the portfolio, that's where the money comes from. When we have to rebalance, so we took money out of domestic equity and put it into some of our real assets, our real estate and our agriculture. It comes out of domestic equity. So we're consistently trimming that over allocation and going into where we're under allocated. But again, 29.1% last year on a gross basis, 28.4 on a net basis. Longer term, You look at your 3-year return. I'm sorry, your 5-year return, it was 13%. That was in the 6th percentile of our public fund universe. And our 10-year return is 10.1%, and that was in the 7th percentile of our public fund universe. So your top
Hey,
decile.
Greg, can I ask you a quick question on those
Yes, ma'am.
percentiles?
Yep.
When you're saying the 22nd percentile, you mean we've, does that mean we've outperformed 22 out of 100? Or are you saying that it means we've outperformed 78 out of 100?
Lower number is good. So
Okay.
a higher percentile ranking means you've outperformed, or 22nd means you've outperformed 78% of the other public funds in that universe.
Okay.
And
All
that's a universe of roughly 143 public funds across the US.
Okay. Thank you for the clarification.
So yes, lower numbers are better. Again, we're all seeking, top, half of an appropriate universe. We'd like to see numbers in the top quartile. Top decile are pretty good. So 6th percentile, 7th percentile, longer term. A lot of reasons for that. If I could point to a couple, the biggest one I think is we've been void of hedge funds. A lot of public funds have made the mistake long term of getting into hedge funds to quote unquote de-risk the portfolio, and they've gotten a whopping 4% over the last 10 years. So when we run our allocation and we look at the prospects for returns in hedge funds, we find better value, better return prospects just in plain old equities and fixed income and real estate. So that's where our hedge fund allocation ends up. And that's why you have that over this 10-year time period. That's why you have that good percent ranking. Again, this focuses mainly on the fiscal year return. So this is your 1-year return. Large cap last year was up 44.2%. That was again, it's 30% of our portfolio. That's going to drive your performance. We actually had some decent performance out of your mid cap portfolio. Mid cap and small cap outperformed large cap. So we had mid cap up 49.2%, small cap up 42.7%. There's a little bit of underperformance in that number because of I'm going to call it the GameStop effect, and I'll explain that in a second when I get to Atlanta Capital. But you can see here last year the small cap index was up 62%. Your portfolio is up 42.7%. Again, go back to large cap, 3-year return, 19.9% versus 19.1%. These are going to be closer to the benchmark because we have a higher proportion of large cap indexed. So, you're going to be a little bit tighter to the benchmark. 5 years, 20.1% versus 18%. So outperformance 3 and 5 years, slight outperformance over this last year, really due to the outperformance of Cornerstone. Large cap, by the way, is your SSGA index fund. It is Cornerstone and for large cap value, and it's Wells for large cap growth. Mid cap is a piece of index fund, and it is Davenport is your mid cap manager, and small cap is made up of an indexed Russell 2000 growth index and Atlanta Capital. That is a kind of a quasi small cap value. So again, all these returns here in green, you can see the performance is in excess of the benchmark for 3 and 5 years for all large cap, mid cap, and small cap. Our international portfolio is made up of 2 pieces, made up of developed markets, made up of emerging markets. Developed markets is Artisan Partners, and there's an SSGA quantitative value fund in there, as well as a piece of EFA index fund, a passive index fund. So there's 3 pieces in our developed market portfolio. The portfolio returned 31% for this fiscal year versus the index of 32.4%. That's an indication, or it's really there because of the underperformance of your growth manager. We had a lot more issues with growth managers underperforming the growth indices over the last year than we have value managers missing their benchmark. Mainly because, you had to own 4 or 5 stocks that were, in excess of 5% of the benchmark in order to get those growth returns. And we see that with a lot of the growth managers over the last 12 months. 3 years and 5 years, you're still ahead of the benchmark. 3 years, 9.2 versus 8.3. 5 years, 10.5% versus 10.3. Emerging markets, a little bit better return there because Axiom is more of a core manager. So this is made up of Axiom and a piece of passive emerging markets. 42.3% for the last year. The emerging markets index, the MSCI emerging markets index, is up 40.9%. 3 year, again, this is all because of Axiom. 13.9% versus 11.3 and 14.6 versus 13 for 5 years. Fixed income, I would venture to say I was surprised we even got 1.9% out of our fixed income portfolio, with interest rates rising over the last 12 months. They've been volatile, but they've risen in general. The index was down 30 basis points. But this is all Earnest at this point in time. Earnest Partners, they have your entire fixed income portfolio was up 1.9%, 200 basis points of outperformance versus the benchmark. Interest rates fell during the year, which gave us that I got it backwards. Interest rates rose. Earnest is a little bit shorter than the benchmark, so they outperformed based on that, and they're a little bit lower quality. So last year, if you remember what happened is the index was up 8%, interest rates fell, which gave us positive return, and it was government securities that got most of the return last fiscal year. It kind of everything flip-flopped, interest rates went up, and lower quality bonds, though the plus part of our core plus portfolio, gave us this 2% outperformance for the year. Longer term returns, again, 3 year, 5 year, 10 year. These are for bond numbers are not that bad. 5.6% versus 5.3, 3.5% versus 3 for 5 years, and 3.9 for 3.4 over the last 10 years. I mentioned when I first started that one of the biggest reasons for outperformance of other plans over the last 10 years is really your lack of hedge fund exposure. Well, the other part of it is when you don't have money in hedge funds, where does it go to? A lot of it tends to go into what we call real assets. These are your real estate and your 2 agriculture managers. Prudential manages the real estate in their PRISA and PRISA 2 portfolios, one being core, one being core plus. And we have 2 agriculture managers, one of them being Ceres Partners and the other one UBS. The combination of those 4 pieces gave us 8.9%. Show that versus the benchmark. We give you a custom benchmark made up of the NCREIF Odyssey, open-ended, domestic, commingled, I forget what that stands for. And the NCREIF Farmland was up 7% over that 12-month time period. So you outperformed by 1.9% for the last year. And the biggest thing to remember, if when we took these real assets, when we funded our real estate, our agriculture, we took the money out of bonds. Real assets are our protection against rising interest rates. Interest rates go up, value of your bonds go down. Real estate and farmland and assets of that nature don't necessarily do that. So again, you see the exact opposite of when interest rates go up, you get negative return in bonds. We've pulled off 8.9% return in your real assets. That over time is going to lead you to that top decile performance. Any questions on the overall performance? I've kind of gone through all these pieces already, but these are your current managers. State Street Global Advisors is our passive manager. We use them for a lot of different pieces. There is one change over last year. We moved this passive piece into a fossil fuel free benchmark. The actual full name of it is Fossil Fuel Reserves Free. So if you have any questions about, why you might have some energy exposure in your fossil fuel free index fund, the answer is in the definition of reserves. And we can talk about that if you want to, but the total exposure to energy companies by our definition is about 0.33%. So it's 1/3 of 1%. So that's how far we've gotten that exposure down in that passive portfolio. Cornerstone is your value manager. I think we talked about those. Wells Capital is growth. Davenport is your mid cap. Atlantic Capital is your active small cap. And again, we've gone passive with the small cap growth. We're active with our small cap value. Artisan Partners is your international growth manager, paired with the international value piece of SSGA. Ernest Partners is your fixed income manager. We moved them to what we call Core Plus about 3 years ago. Core Plus, all we do is add in a little bit of high yield into the portfolio. And they, because we use an active manager for that, they have the ability to get into and out of the plus area of Core Plus as they see fit. And then Prudential is your real estate manager. Again, you have two different portfolios with them. And you've got Prissa, which is your core, and Prissa 2, which is Core Plus. Ceres Partners is let's just call them your conservative agriculture manager. They have predominantly row crops. And UBS not only has row crops, but they venture into permanent crops. And we can talk about that if you really must. So that's who's managing your money. We're your consultant. We've been here since '98. Talk about recent changes. These are the things we made over the course of the year. We implemented the fossil fuel ESG guidelines. I've given some details on that, which we can go over again, but your total energy exposure is now 0.57% of the entire portfolio. And we're running approximately 54 basis points in annualized fees. A little bit lower than most because we use a lot of passive investments in this portfolio. So it's probably a little bit lower than average at 54 basis points. Start breaking down some of that performance. The large cap performance, as I mentioned, Cornerstone kind of carried the weight in the value side of things. Cornerstone was up 59.7% last year. 24th percentile. Oh, I got that wrong. I think it's supposed to be 5.97. 24th percentile, 53.4% versus 43.7. 3-year return was 17.9 versus 12 in the 17th percentile, and 5-year 19.3 versus 11.9 in the 8th percentile. Very good job from the value manager. Again, I've seen a lot more success by value managers over the last 3 years beating the value index than I have with growth managers beating the growth index. And you see that with Wells here. Wells last year over your fiscal year underperformed by 60 basis points, 41.9% versus 45, still in the 38th percentile. So they're top half of that growth universe. So if you look over the last 12 months, I mentioned the 4 or 5 stocks that they had to have in their portfolio. You probably heard of them as the FANG stocks: Facebook, Apple, Netflix, and Google. You can probably throw Amazon in there. Amazon's done pretty well. But they kind of, they got away from Facebook, they got away from Google. But a lot of managers have done that. And that's really indicated by that 38th percentile. A lot of managers have said those stocks have got to stop getting the performance they have been. You've kind of seen it here in September. It's not reflected in these numbers, but you've seen these portfolios do a little bit better. You see the growth managers that abandoned Facebook and Google, 2 years ago because of valuation. You've seen them come back a little bit. I don't have Wells's. I do have Wells's numbers, and I can show you those through August. But it's really here in September that those FANG stocks have started to give back some of their returns. Mid-cap side, 45% for Davenport, 45.1% versus 49 over the last year. So a little bit of give back from their great year last year, just underperformed by 4.7%. The 3-year return is 21.9% versus 16.4. We don't have a 5-year return for them yet. Davenport was a relatively recent change in the portfolio, but 25th percentile over the last 3 years. So top quartile performance for them. The underperformance in small cap really came from Atlanta Capital. Now, if you've been here a while, you've heard me talk about Atlanta Capital. Atlanta Capital is what they term a high quality small cap manager. So by high quality, companies have to have positive earnings. And in small cap value land, not all small cap companies have positive earnings. I talked about the GameStop effect. So GameStop is a perfect example of some of the stocks you had to hold in order to get this 73% return over the last year. That's not negative, that's my typing ability. 73.3% for small cap. So if you didn't own Facebook, if you didn't own companies like AMC, that are companies that had negative earnings, they're high debt, their balance sheets are not very attractive. What happened was, GameStop is a great example. You had a groundswell, Robinhood type of purchasing, and then you had hedge funds jump in, and hedge funds drove the price up. And then when the hedge funds made their money, they jumped out. So GameStop went, had a 400% return and then dropped back down to levels. So, or they have lately. So Atlanta Capital doesn't own those. So Atlanta Capital does for you is their long-term returns. They tend to outperform negative markets. They hold their value and even have positive returns. So that's why you look at their longer results. Even with this 1 year, if you talk to Atlanta Capital, they say, well, 37.3% is one of our best years ever, as far as a total return. It's one of our best 12-month periods ever. They've just underperformed their benchmark by a lot. And again, the reason why are those non-earning stocks that they don't own. Longer term, they're still doing fine. If you look at their 3-year number, they're 25th percentile. 5-year number, they're 34th, and 10-year number, they're in the 8th percentile. They've done very well in the small cap value space. And again, most of the time when the markets are down, in fact, all the time, you look at over the last 10 years, every market that had a negative return, Atlanta Capital outperformed those markets, those quarters, and did so by a pretty substantial amount. So that's where they add their values when the market's down. They came back again in July, and they're doing very well versus the benchmark here in September. International, again, growth managers, Artisan underperformed slightly on the growth side, 25.7 versus 31, offset a little bit by SSGA in the value side. Again, here's its growth value split, with growth managers having a little bit harder time beating the benchmark. Value managers have tended to outperform, and that's the same case with SSGA. Emerging markets on the emerging market side, I think Axiom beat their benchmark by 4.2%, 45.1 versus 40. Top half of the emerging markets benchmark. And when you wrap everything up again, you look at everything, we underperformed just slightly. When you take all those pieces by 70 basis points, again, the biggest piece of that, because it's a larger allocation, was the underperformance by Artisan on the growth side. Longer term, again, because of the performance of SSGA really on the value side and Axiom emerging markets, we've beaten that the MSCI ACWI ex-US, the All Country World Index, minus the US, by 20 basis points over 5 years and by 210 basis points over 10 years. On the fixed income side, as I mentioned, interest rates rose slightly during the year, giving us negative returns as far as principal. Higher quality marked by governments underperformed. Earnest had a shorter duration. They had and high yield exposure led them to outperform the benchmark. They returned 1.9%. That was in 28th percentile. 3-year and 5-year, and again, we haven't had the entire time period here with high yield. So Earnest done a great job on the fixed income side. You see they're all shaded in green and beat their benchmark by 50 basis points annualized over the last 10 years. Real estate and farmland have done pretty well for the portfolio. Again, you saw the total portfolio up about 8.7%. Again, real estate is Prudential and agriculture farmland. That's our series and UBS investment. I always like to do this, and I cut and paste our recommendations and outlook from last year and see how close I got. And you know, we talk about, you know, active managers producing positive alpha, and you know, that's the way you outperform other plans. That's the way you add value in your portfolio, is you have active managers that produce positive alpha. Well, last year, because of Wells, we had a negative alpha of 0.88. So with Wells Capital, you know, they had negative alpha. All your other active pieces, Cornerstone was 5. And again, this is over the last 3-year time period. So with their underperformance this year, Wells brought us down to 0.88. Large cap growth is the biggest piece of this portfolio, other than the passive fund. Wells Capital had a negative alpha. You look at Cornerstone. Cornerstone over the last 3 years has a positive alpha of 5.14. Davenport 7.25. Atlantic Capital 5.21. So Wells Capital, and you'll see in my recommendations for this year, we need to see some improved performance from Atlantic Capital. We need to see that positive alpha in this portfolio. Now, 5-year and 10-year are better. 5-year and 10-year are positive, but I'm looking at the current trends in this 3-year number, and 0.88 to me is not acceptable. Again, that is Wells Capital on the growth side.
Hey, Greg, Scott here. You just said Atlantic Capital. Did you mean Wells Capital?
Talking about the underperformance of Wells Capital. Yeah, Atlantic Capital had a positive alpha of 5.21.
Got it. Thanks.
I apologize if I misspoke. International fine. The 3-year alpha for international is 5.13. SSGA has a positive 3.33, and Axiom is 4.59. If you have the question of how can it be 1.53 when SSGA is 3.33 and Axiom 4.59, the answer is your index fund. Index funds by definition have an alpha of 0. So the benefit of index funds is not to get alpha. The benefit is you will never underperform. So you're capturing 100% of the upside, 100% of the downside. By definition, your your alpha is 0, your batting average is 1,000. So that's the payoff with passive. The other part is we get a little more efficient with fees. With your index fund costing you, I think 4 basis points. Active management a little bit more expensive. Last year, I told you the elections would have an impact. We have not yet, I think, seen the impact of inflation and a slowing economy. This is still in play. Remains to be seen what goes on. The market is on a daily basis trying to figure out what's going on as far as inflation, what's going on with rising inflation is gonna stave off growth. That's what drives the price of the stocks. The market's still trying to figure that out. 2 days ago we're down 600 points in the Dow because of slowing in a single Chinese company. So you see the impact of what's going on in the market. This is still in play. We're still trying to figure it out, and we're still trimming equities when we can, to get down to a lower percentage. But that's still in play, and we haven't changed what we've been doing. When we need cash or we need to rebalance, it all comes out of equities. I may have been a little wrong about COVID, but COVID isn't over yet. I talked about COVID having impact on real estate and having an impact going forward. It really didn't. In the overall real estate market, it was kind of split. So when you think about real estate, the core to your real estate investments are residential, industrial, retail, and commercial. It's done. Real estate markets have done very well in industrial, which is warehouse, and residential. So people are sitting in their homes, or if they don't have homes, they like to have nice apartments, and that's what you've got in this portfolio are high quality, high grade, grade A apartments that people are sitting in, and they're calling Amazon and having stuff delivered to them. Stuff from Amazon has to come from a warehouse. So those two have done very well. Commercial has been it's been flat, really, because you've had some companies that say, well, we don't need to have the office space. We don't need to have people sitting in an office. We can have more people work from home. As you can see, we're all sitting in our homes or our offices by ourselves. But then you have other companies that have said, well, we need to have people in place. We need to have people in an office. But what they've done is they have now expanded their footprint so they can keep people farther apart. The trend in office space over the last 15 years was to put more people into cubicles and cram more people into a space. Now you're starting to see that go backward. You start to see it going the other way. And people are now, 6 feet apart. They have their space, but companies need to get more real estate, more square footage in order to change that footprint. So it's kind of been a give and take with the commercial side. Retail has been terrible. There's plenty of companies that have gone and shut their doors. Strip malls. I think if you drive past any strip mall, they've got a sign out, space for lease. Retail has been terrible. On the positive side of things, these real estate managers have tended to be light in retail anyways. Any retail that they might have had would have been grocery anchored, and grocery anchored retail have fared a little bit better because people still go to the grocery store. And sometimes when they're at the grocery store, they say, oh, I'm going to stop in and buy a pair of shoes. And so you've kind of seen that dynamic. So, Prudential has fared pretty well as far as the downturn in retail. We talked about ESG investing. We implemented that over the last year. As I said, we've gotten your exposure down to 0.57% of the entire portfolio. All of your active products have a 0% weighting. So the active products that are separately managed, Cornerstone, Wells, Davenport, Atlantic Capital, have 0% in energy. So we've kind of done that, and so far we have not seen any impact from that, from establishing those guidelines. Any questions on anything that I've gone through yet before I hit the recommendations for next year?
Yeah, Greg, this has been as we think about sort of the big structural things that could impact the portfolio over the course of the next 12 months, certainly this question about inflation and whether it's short-term or long-term is one of the larger ones. Given the fact that over 50% of our portfolios in U.S. equities, can you just walk the commission through what you would expect to happen to the portfolio if there was structural long-term inflation?
Yeah. So let me kind of.
I'm not asking you to predict whether or not it happens, just to sort of walk us through how the portfolio will react if it does happen.
Yeah, might be easier for me to do this. So when you look at this portfolio, look at the managers you have in here. Aside from the passive pieces, so we have all these pieces here: SSGA, the S&P 400, the Russell 2000, the EFA, and the emerging markets.
Are you referencing a different document just so that we all can see it? Sorry.
Oh, did my screen not change?
No.
Okay, hang on a second. Try this again. How's that? Do you
That
not
is
see it?
different.
We can see that.
Yeah, okay. So again, this is that book we send you, but you look at the entire portfolio and you look at the active pieces. When we run these searches, Ben, we're really looking at I advise you guys to number one, look at return, and then look at some risk adjusted type of number. Look at batting average, what managers that beat the benchmark more than they lose to it. Then we look at upside capture ratio, downside capture ratio. So most of the time, I tend to push you guys towards higher quality portfolios that tend to outperform down markets. So yes, it's 50% of the portfolio, but we tend to have better performance in down markets because they're higher quality portfolios. Atlantic Capital, a perfect case of that. Atlantic Capital, when the markets go down, a lot of times you'll see them with positive returns. Just because the small cap market goes down and people dump those companies that have no earnings, so GameStop can go back to zero, and the companies that they have in their portfolio, fare rather well. So that's one way we try to avoid it. The second way is just we are diversified across all these asset classes, from large cap, growth value, to mid cap, and down into small cap. But we tend to be towards the higher quality end of domestic equity. We tend to outperform down markets and keep up with up markets for the most part. That's what's happened over the last number of years.
And Greg, an inflationary situation would be considered an up market?
Inflationary normally leads to negative markets, Scott. Normally, inflation is not good. Inflation is, you can't pass everything on to the consumer because if you do, the consumer stops buying. If you don't pass those costs onto the consumer, then it's going to hit your balance sheet. So inflation is not good for anybody. You know, if you're paying more, if you want to go into, I forget when I went in and bought 4 apples for the other day, but if you're paying $10 for 4 apples, you're not going to buy a lot of apples.
Right.
Yeah, I mean, Scott, think about it this way. I mean, if cost of labor goes up for picking that apple by 50%, you know, you can't pass 50% along to a consumer without them deciding not to buy an apple. And, you know, certainly, at least it seems like we're looking at whether or not it's temporary or long term, you know, we're going to be looking at some inflation. And so I just am trying to get at the heart of, okay, what should we start to expect to see the portfolio do? And it certainly seems like with this level of exposure to U.S. equities, which has been great in the past, if we're going to see some inflation, we probably should manage our own expectations that might have a negative impact going forward here.
Yeah, and one of the reasons I asked the questions to try to understand it better is I think we're going to get hit twofold with inflation, right? We're going to have to be careful with our investment portfolio, and our outlay is going to increase, right? Because to keep our employees, our salaries are going to increase, and in doing that, the amount of annual, you know, adjustment for the pensioners is going to increase.
Right.
Yeah,
And
go ahead.
and things that generally do well in inflationary times are things that we have a fairly low allocation to, you know, real estate, ag, farmland, that sort of thing. So our portfolio is not well situated if we're in any type of long-term inflationary environment.
Right, but remember, long term, you still have a 7.5% assumption rate. So
I'm not talking relative. I'm
Yeah.
just talking about what we should see on an absolute basis.
Oh yeah. So you know, this 29% is awesome. I wouldn't expect that going forward. You know, and you know, the good news is you know,
Right.
we don't really plan
Yeah.
for 30% years. We don't really plan for negative 20% years, but we know we get them. And you know, that's kind of baked into the whole allocation process. And over this last 10 years, so going back to 2011, there's some down markets in there. When you think about the last 10 years, more up than down, but there's some down markets in there, and we still pulled off a 10.1% return. So long term, we're looking, you know, is that 7.5% a valid return over the next 10 years? That's kind of what we're looking at. And so, and Ben, not that you asked me to say, hey, look, should we get out of equities? And I would tell you no, because you still have to remember that 7.5% bogey. But I do have clients that say, hey, look, we should cut our allocation of equities down. It's like, well, what are you going to do if equities go back up? You know, you still have that. You've still got to keep your eye on that 7.5% over the long term. And you know, the example I use is if you go 100% to cash, I can guarantee you over the next 10 years, you're not going to get 7.5%. So that's if you go to cash, you're not getting 7.5%. And that's kind of the way I have to look at it, is I still have to give you the possibility of getting at 7.5%. And that's why we have equities in the portfolio. Yes, we trim equities when we can. And we have a band around that 50% target. And that, you know, hopefully we get that to come down with trimming the portfolio, you know, putting more money back into real estate, putting money into agriculture, rebalancing back into fixed income, even though that's not as attractive. You won't lose as much in bonds as you will in equities in an inflationary environment. So you know, that's kind of where we look at the allocation.
Hey, Greg, bouncing around on you here. Relative to other plans similar to us, where do we fall on a scale in terms of our exposure to active management? Are we more active than similar plans, less active than similar plans?
I'm going to, it depends. is my answer. So a lot of larger plans, and when I say larger, $1 billion plans are probably more passive, just because they've gotten to the size where they hire 5 large cap growth managers and they create the index anyways. So why not just go passive? So you've got less passive than real large funds that have gone more passive lately. You've got more passive than smaller plans that can actually take a good bet on an active manager, and not make it and not have to hire 2 or 3 managers. So I would consider you guys kind of a mid-range type of portfolio at a little over $200 million. And again, if let's see, what do we have in Wells?
All right, so let me re-ask the question. Compared to other $200 million funds, where do we fall on the active on the active basis?
You probably have a little more passive, just because we've taken bites out of each asset class.
Mhm.
Whereas a lot of plans will just do S&P 500 or S&P or Russell 3000. They'll do the equities. They may not necessarily hit the international or emerging markets. So I think you're a little more passive when it comes to other plans of let's say in the 200 to 500 range.
Okay.
And Ben, with one exception in Virginia, I would say compared to other plans in Virginia where we have a higher allocation to passive managers than they do.
Okay.
There's one that's like all passive.
Who's beating us? Who's
Well,
beating us on that?
I think it might be Norfolk. They just went all passive at one point.
Oh, God
so.
bless them.
Yeah, but how are the returns?
They look exactly like the index, Greg.
So Ben, did I answer your questions?
You evaded them very well, Greg. I give you credit for evading them.
While we're on this report, again, just what am I trying to do over time? I'm trying to add positive alpha to your investments. This is the last 3 years. How do we add positive alpha? Well, we beat the market more than we lose to it. We capture more of the upside and less of the downside. That's that higher quality, well-diversified portfolio. We're doing very well on an overall basis. There are points of weakness. Again, I told you the 0.88 negative for domestic equity. That is entirely Wells Capital over the last 3 years. Capturing a little more of the downside than we'd like. 100% of the upside, 107% of the downside over the last 3 years. Not what we're looking for. We need to see some improvement there. I told you about index funds. You don't see SSGA here because we changed funds. We changed our history stream. So you won't see them pop up here on their own for 3 years, but they are included in that number. But just look at the S&P 400. Like I said, the definition of an index fund is your alpha is going to be 0. Your batting average is going to be 1,000. You're going to capture 100% of the upside, 100% of the downside. That's what you're buying into, but you get it for 4 basis points. So you'll see that with all your passive pieces. They track the index. By definition, you are going to get 0 alpha and 100 batting average. I'm going to stop sharing that for a second. All right, so let's go back to, give me a second. I've lost, oh, there it is. Recommendations going into this current year. Again, keep an eye on Wells Capital. They've underperformed their growth index. It's been mostly the last 3 years. They have beaten the S&P 500 as a growth manager should do. Their 5-year return is still slightly ahead of their growth benchmark. We can't see this underperformance continue again because it's a bigger piece of the portfolio. It's 10% of the target versus your value manager, I think, which is 7. So I would consider wells on watch for performance reasons, and we'll pay attention to what's going on to those wells in the future. Continue to trim equity as cash flows warrant. As I say here, take some chips off the table. Is there a correction coming? You know, I'm not gonna make a call on that, but you know, it sure feels like something's coming down the road. So you know, be wary of what's going to happen. Be wary of a correction, whether it's a 10% correction or a little bit less, a little bit more. You probably have that you know, coming down at some point in time. And again, we have
Hey,
to.
Greg,
Yep.
sorry to bump in here on you. Sort of trim, I sort of look at this third bullet point and would like to think about it a little harder. The idea of trimming equity as cash flows warrant, and then the idea of taking some chips off the table are, in my mind, sort of two different things, right? The one is we have a need for cash. We're going to use equities there. The take some chips off the table is let's make an active decision to how, for whatever reason, whether it's we need cash or not, to reduce equities. Are you recommending we just continue to use our equities as the place we find our cash flow? Or are you recommending that we actively make a decision to reduce equities and put it into a different asset class?
Well, unfortunately, the asset class that I think we're most underweight in are those the real assets. And those are on like a capital call basis. In fact, we have some money right now that we're due to UBS. Jason?
Yeah, we did $1 million to Ceres in June, $1 million to UBS in July, and 1.2 million in Prissa this month. So we're waiting on the rest of that capital call. But so we have made some small moves there.
Yeah, and we're taking another $1 million out of SSGA to fund the next call for real estate for Prissa.
And that's happening next week. Yeah.
Yeah. So that's how I'm posturing that is, you know, take these chips off the table as the markets warrant. Other than, you know, you're talking 5% overweight. And you know, you're underweight fixed income. So you know, moving that 5% either way is not really going to save or get you more. You know, it's only a 5% weighting. Let me stop share this. All right, so most of the overweight is here in large cap, and we're taking $1 million of that for real estate. The other pieces are not all that overweight. And again, you look at the underweight, it's real assets. Again, we're adding $1 million that we've added to that. And the reason why real assets are underweight is, you know, they've gotten 8%, but equities have gotten you 44%. And then fixed income, and fixed income is not that attractive either in a rising interest rate environment. So those are the two places we're underweight. Real estate, again, is a sticky asset class. It's a capital call process. So you commit the assets and the money goes in there, you know, maybe 3 to 6 months. Fixed income, you're just talking a 3% underweight to fixed income at the moment. So we're not all that far off of our long-term targets. This was higher.
Mm-hmm.
I guess then your question was not do we stay the course on our current allocation, but should we modify it? Is that what I heard?
I think Ben was saying, do we deal with these differences, not so much your targets? Am I correct? Ben?
I was just trying to get some clarity about what you meant, Greg, in terms of
Yeah.
sort of trimming versus, taking some chips off the table from an equity perspective. And what I'm hearing you say is you don't want to take some chips off the table, go underweight on equities
No.
at this point. You want to, as cash is necessary, work towards these targets.
Correct. And like I think we were 6% over last year, and that's why we started trimming this portfolio. Even with the markets up as far as we were a lot more overweight, and we've taken that and put it down into real assets over the last year.
Right.
When Jason says, hey, we need $3 million to replenish whatever fund, most of the time over the last number of years, it's come out of equities. So that's what I mean by trimming it for cash flow. Ben, I think you were in one of the meetings when I talked about, our allocation process, when I called it a strategic allocation with a Dino tactical overlay. And it means
I like
absolutely
that,
nothing.
Greg.
Yeah. So here's our strategic long-term, target, which we're not, that's designed to get you that 7.5% over the long term. That's the strategic part. The tactical part is we're never going to be, exactly at that target. We're going to have market movements. And so the tactical part is, over the last 10 years, we have been overweight large cap because that's where the returns have been, specifically large cap growth and Wells Capital. So we strategically will be overweight that asset class just because, again, we can't move on a dime. This is a big ship with a small rudder. We can't move on a dime, but we can take things and, from time to time and rebalance these tiny overages and unders over time to again, try to stay at that target allocation the best we can. What normally happens with this process, with this Dino tactical overlay, is we will over time be overweight most of the time to the outperforming asset classes. We will miss the peaks and the troughs, but we won't miss them by that much. We're only talking 3.7%.
Yep.
Any questions, anyone? Let me see if I have that. Since we talked about it, give me a second. Jason, I'm just trying to find my fossil fuel list. All right, try this again.
Yeah, and while you're doing that, if you remember when we first started the discussions about fossil fuels, we estimated that energy represented 2 to 3% of the portfolio.
That's been a nice movement.
All right, so here's kind of the work we've done over the last year. These guys here with the asterisk are commingled funds. We don't have the ability to tell the manager to get out of certain holdings. You're vested in the commingled fund, and that's what you get. Wells, Cornerstone, Davenport, Atlantic Capital, there are separate accounts. So they've got an account at Sunbank? No.
SunTrust.
SunTrust. So they've got accounts at SunTrust. They buy individual stocks for us. We can instruct them, and we have instructed them to divest from their energy holdings. So you can see none of those managers have energy holdings. Atlantic Capital had one in there. They had some exposure. It was a company called Dril-Quip. So it was not an oil company. It was more of an industrial company that makes drilling equipment and drill bits. And it is kind of one of those stocks that falls into one of two categories, whether it's basic industry or whether it's energy. Drill bits are used to, not only extract oil, but to extract other, or to, they're drillers. So they finally did get rid of that holding, but that was the only one you had in this portfolio. But you can see here the total exposure now is 0.57%. The biggest exposure you have is in Axiom, just because it's a big piece of the emerging markets index. So logically think about it this way: emerging markets, Brazil, Russia, India, China. There are two countries that use more oil than the United States and have a bigger carbon footprint than the United States, and those countries are India and China. So it kind of makes sense that emerging markets is where you see a lot of the exposure. You don't get a lot in your total portfolio from Axiom because it's a smaller target allocation. You only get 0.6% from that 4.1% in the Axiom portfolio. But it's still, that's your biggest piece. I did go down through here and give you a list of all the portfolios and exactly what type of exposure you have. And when I sent this to Jason, I had the same question he did: is why is Valero in the fossil fuel reserves free energy portfolio of SSGA? Well, Valero does not have any fossil fuel reserves. And it's all in the definition of what the fund is. So most of the ones you see here are there's small allocations of the fund, but they're mostly gasoline, NOV, Phillips, Valero, Marathon Petroleum. They're all gasoline distributors. And that's the way it was explained to me. Again, small percentages in that, but again, we cut your exposure to energy from about 4% down to 0.33 in that one investment. These ones here, they don't have an energy free sleeve of the S&P 400 or the S&P 2000 or the Russell 2000 growth. So you get what you get what's in the index. And here you see the mid cap holdings in the S&P 400. Again, I can't find a fossil fuel free index fund with any provider at the moment. I've been looking since we kind of went through this process. I can't find one. They're only in the large cap side. Russell 2000 growth. You see the names that are in the benchmark. There are a good number of names in the 2000 benchmark. Not very high percentage holdings in any of them. In fact, some of them they don't even own. Kind of a misnomer that the Russell 2000 is not a complete and total replication of the benchmark, because a lot of these smaller pieces they don't even have. But you can see going down through here, not a lot of exposure in the growth sector anyways in energy. This is the international side of things. Of course, the big ones you're going to see in international: BP, Royal Dutch, Total, the French oil company. You're going to see the big ones in the EFA index, and you're going to see them in your holdings. Artisan has one. It has one at 1.14. It has Reliance Industries. Again, you go down through here. Again, you're going in international. This is SSG International. It's the value piece. energy is a bigger piece of the value index than it is of the growth index because of its dividends. So you see Royal Dutch, you see Total.
Greg, are you with us?
Might be frozen.
I believe we lost him.
Holdings. Reliance must be it's a popular holding. Hopefully it's a good one, but it kind of weaves its way throughout the entire portfolio. But you got Lukoil, and you've got Reliance in your emerging markets portfolio. I left all these companies in here. This is again the passive piece of SSGA and emerging markets. I left all these in here just to show you the exposure. Even see there's a lot of zeros in there, but just to show you the exposure of energy companies in the emerging markets index. So there's a lot of names in emerging markets. A lot of them, as you look down through them, they're Chinese. They're Indian. You've got the Brazilian oil company, Petróleo Brazil. I can't even pronounce these darn things. But those are the one, and you'll see Polish companies, you'll see Russian companies in here. There's an Indian company, Bharat Petroleum, that's in the emerging markets index. So that's where you get most of your emerging markets exposure, is within the emerging markets pieces of the portfolio. But I just wanted to show you some of the actions we've taken over the last year, again, to get as trim as possible from these, from your energy exposure.
Greg, is that part of anything that's been sent out to us yet?
Yes, I sent it to Jason. I just put this together for this meeting, but you guys should have it. Jason's got that.
Yeah, we just got that. I can send that out to everybody.
Thanks.
Yeah, I
So
think that's
again, you
helpful.
look at. Go ahead, Jason.
I was just going to say, I think it's helpful to see where we've made progress and where some of the exposure still is. So.
Yeah, so if you look at the total exposure, of course, because it's a big part of your portfolio is really here. It's a huge, it's a 0.1%. So it's 1/10 of 1% of the total portfolio. But that's where you see your exposures now in your passive pieces for the most part. And even Axiom with, they've got the biggest single piece, but it's less, it's just slightly higher than 1/2 of 1% of your total exposure.
Good progress.
All right.
Now, I'm always looking for managers that might have, a fossil fuel product, free products. Unfortunately, in the emerging market side, there's not many, because I showed you the exposure to energy in emerging markets. So either you're going to be in that asset class or out of the asset class. I mean, if you want to get totally out of energy in those markets, you're just going to have to get out of the asset class, because there's no options for energy free emerging markets. I've found some on the international value side that are fossil fuel free, but their returns are dismal. I'm not sure if that's because they have been out of energy. It doesn't make sense because energy has underperformed other sectors. So it's just that they're hoping they can get into investment portfolios just because they are energy free and not because they have good performance or a good process. I won't give up good performance. I won't recommend giving up good performance just because you can get out of energy. Now, especially when we're only talking, 0.08% of your portfolio. I'm always looking for those options that, my goal, as directed by you, the commission, is to get that as close to zero as possible. That's my goal. I will look for those products, but I haven't found anything worth, going into or presenting to you as a commission. But that's my goal.
Right. Well, I know there are a couple more smaller items on the agenda, so we'll probably wrap this part up here unless anyone else has any more questions for Greg.
Nope. Thanks, Greg. Appreciate the presentation and the good results.
I miss Charlottesville in the fall. I miss my walk down the mall to get coffee.
Well, it's only day one of fall.
I know, I still miss it. I told my Florida clients, it doesn't matter what happens with COVID, I will be in Florida in February. I didn't really mind not seeing them in August.
Well, great. Well, thank you, Greg.
All right.
Thanks, Greg.
I will turn it over to Lisa to see if she has any updates for us.
I do. Thank you, Jason. Can everybody hear me?
Yes.
Great. So just a few housekeeping items I wanted to let you all know about. So on September 7th, Councilor Hill presented our request to amend city code regarding the length and number of terms for our appointees to the commission, and it was well received. So thank you, Heather, for doing that. And a second reading was done on Monday, September 20th, just this past Monday. So yay, progress. Number two, just want to let you know about our next meeting. It's October 27th, and we're going to be having our actuaries do a presentation. And that meeting is going to be done via Zoom. But I did want to just address that because I've had people ask me, when are we going to go back to face-to-face meetings? So we are going to continue virtual meetings until City Hall is fully open. And I'm not a mind reader, so I'm not exactly sure when that's going to happen, but the last I heard, probably not until the end of November or maybe December. So definitely plan on continuing Zoom for a little bit longer. But if there's any change at all, I'll definitely let you all know. And then finally, the November meeting, it's scheduled for the day before Thanksgiving. And I just wanted to put it out there in case you guys, I'll take your direction, but if you want to change it, start thinking about it now.
I'd definitely be up for changing that.
And that's it. So
Yeah, the city
you.
schools are off on that Wednesday, so I would prefer to not have a meeting on that day.
Would it be possible to move it to maybe a week ahead?
And what are we doing like in December too? Because that's always an issue. Because I think last year we actually combined a meeting somewhere early December to kind of accomplish both the late November and the late December because they both have holiday kind of conflicts at that time. So I'd be, go ahead.
Last year we moved the November meeting up a week. We had it earlier and then we did
Okay.
not have a December meeting. But I do think that's an idea, Heather, like we could push it back a week and then just have kind of a combined
One meeting.
It's up to you guys.
I think
And we
really
can think about it and
December's
decide
strategy.
next time too.
Maybe we could decide in October. I don't know of anything pressing that's going to be on the agenda for that meeting unless something comes up when the actuary is presenting that we want to meet and talk about, before we accept the report. But there's nothing else that I can think of necessarily that we would have to discuss in November. So maybe combining a meeting in December might be helpful.
Okay, so we'll just decide for sure next time.
Yep, good idea.
Okay, thank you.
Thanks, Lisa.
Thanks.
All right, any other items of discussion? Okay. All right, was there a motion to adjourn?
Move to adjourn.
Second.
All right, all in favor?
Aye.
All right. Thank you all very much.
Have a good day,
Bye.
everybody.
Bye.
Thank you.